Are we heading for the worst period of inflation ever? Well, in this week's Property Insider video, Dr. Andrew Wilson and I discuss what's ahead for inflation, unpack the latest statements from the Reserve Bank, talk about the unemployment figures, what's happening overseas, and what's happening locally. If you want to keep up to date with what's happening in our property markets, join over 10,000 other people and subscribe to this YouTube channel and click the little bell icon so we can update you every time a new show comes out. What a week it's been. The Reserve Bank Governor Philip Lowe appeared on the ABC and told us inflation is likely to get to 7% by the end of the year, and that the Reserve Bank had no choice but to hike interest rates to bring down prices. Not surprisingly, the media's been full of negative messages and consumer sentiment plummeted. I guess there's all those concerns about rising interest rates and the possibility of a recession. Also during the week we had a big jump in the minimum wage, a 75 basis point raise in the interest rates in the United States, and strong employment figures locally. And Governor Philip Lowe made some forecasts about inflation and about interest rates, which I'm going to discuss in this week's Property Insider chat with Dr. Andrew Wilson, Australia's leading housing economist. And I'm interested to hear his views because I know he's got some concerns about taming inflation, meaning that we could be in for the worst period of inflation ever. Hi, Andrew.
Hi, Michael. How are you?
I've been well, Andrew. It's been an interesting week in property, but the longer you've been in the markets, they just seem to be repeating themselves, don't they?
Yes, we're getting a reprise now of what happened in 2018 and 2019. Same old hysterical headlines, same old predictions of price crashes from the same old suspects. And of course, they'll be wrong just as usual. I'm not sure why those that move into the forecasting realm don't use just firstly the historical evidence to support their position on these cataclysmic predictions of house falls, because the reality is the steepest house price fall that Australia has experienced, and that's December quarter to December quarter nationally, in the modern era, according to the ABS, was just 5%. So we're a long way short of that if we do get to 30%. And that actually was in a period where the market was frozen by fear, with all those headlines that we're getting now about strong price declines. And the market did sit on its hands for about 18 months, but then picked up again as the reality of having to make a buying decision started to restore rationality to buyers and also to bring sellers back into the marketplace. But we will have a similar outcome going forward, I believe. And let's hope this time, Michael, we can perhaps to some degree hold those doomsayers a little bit accountable for all these silly headlines.
Well, let's make it clear, certain sub-markets definitely drop more than that. But when people are saying the Australian property market's going to drop 30%, that's never happened. And the period you were talking about was in 2018, when there was a lot of fear about change of government and upcoming election, some changes to the tax laws. But if we go back to what happened during this week when the Reserve Bank governor went on TV, I think part of what he was doing was trying to lower consumer sentiment, stop demand, because really he wants to stop us spending. One way he's going to do that is take more money out of our pockets by raising interest rates. But he said the board received plenty of criticism on how its interest rate policy had played out. He reminded us that in 2020, Australia was facing Armageddon, prospects of tens of thousands of virus deaths, 15% unemployment, inflation expectations were in the gutter at that stage. But now he's telling us he's expecting inflation to hit 7%, and even by the end of this year. And he also suggests that interest rates, the reasonable rate could be 2.5%. That's, of course, the cash rate, which means the rate you and I pay for our mortgages would be a couple of percent higher than that.
Well, I think he'll be lucky to get away with his predictions of inflation. I think they may even go higher, unfortunately, Michael. We're seeing no easing of inflationary pressures in the US. It does sound like a bit of an excuse wagon to me for getting it wrong, but the Reserve Bank has got it wrong now for a number of years, even pre the pandemic, in regard to the direction of interest rates. Even the predictions they were making earlier this year have been wrong. It is easy to be wise in hindsight about the significant stimulus packages that were thrown at the economy, that would cause some possibility of inflation becoming embedded. That is what has happened. It isn't a Ukraine story, or wasn't to start with. It's a story about too much stimulus, but absolutely correct. We didn't know what we were doing at the time. High levels of uncertainty regarding COVID. We've come out early days with a surviving economy, but we're paying the price now. Look, Australians and most advanced economies were all paid forward, Michael, through the pandemic with a raft of stimulus packages. And now we've just got to pay it back, Michael. That's what's happening. And unfortunately, it's going to mean some tough times. And at the end of the day, the increasing likelihood is that we're going to see unemployment rising sharply as a result of the Reserve Bank slamming on the brakes, which I think it will do now, and perhaps follow the example that was set by the US. Or last week, it raised official rates by 0.75%, which is the highest since the early 90s. And we've only ever raised it once by 0.75%, Michael, and that was also back in the early 90s. So it would be a record increase in interest rates, official rates, if we did get that 0.75%. But there's no use mucking around now. You've got to go hard and you've got to go early. The question is, will it work? And I think that that's becoming even more problematic, that we may sort of get into that position of stagflation where we have high inflation and lowering growth. And I think the big concern rising now in terms of inflation, not just the cost of oil, and I think we're going to see $3 a litre anytime soon, perhaps in Australia, once that support from the government is lifted on current oil prices, petrol prices. But the big concern now, Michael, is food. And I think that's where we're going to see perhaps the emergence of international food shortages. We're already seeing that now. And Australians are experiencing food shortages now in certain items that'll only increase inflationary pressures. So good luck to the Reserve Bank. Let's hope they can get it right this time, Michael.
Well, it would be nice for us, wouldn't it? Of course, they've got further reason to increase their interest rates next month, like you were suggesting, because currently there's a jobs boom and the tightest labour market in 40 years, with the latest ABS statistics coming out showing what's happened over the month of May.
The number would have been actually lower if we had the same participation rate that we had the previous month, but the participation rate increased to a record. Over 3/4 or 2/3 of the population were employed, and that's a record. So that actually pushed the rate up a little bit because we had more people coming into the workforce. If the question is whether we can drag more people out of the population into the workforce to keep the economy growing, or whether we have reached its peak. Of course, we had 60,000 jobs created over the month. But when we look at the April number, it was just 4,000 jobs created. Perhaps it was a little bit of a bounce back over May. But my sense still is that we may struggle to get that 3.5% unemployment rate that the bank is predicting at the moment. And we may have just sort of peaked in terms of the unemployment rate and the participation rate and jobs growth. And particularly given that we're now certainly seeing some more significant signs of migration picking up in Australia, and that'll mean more supply of labour. And maybe that interview that the governor did looks a little bit desperate, was setting the scene for a steep increase next month.
Probably part of the reason the Reserve Bank governor went on TV is to lower consumer confidence. And that seems to be working really well, because the latest ANZ Roy Morgan consumer confidence figures have been the lowest recorded for quite some time, Andrew.
Well, we'll see if those sentiment measures, which tend to be backward looking, translate into particularly retail sales. If we look at retail sales since the pandemic, they've gone through the roof. We've never seen this level of retail sales. And that just reflects, of course, the stimulus packages.
And we've been let out, Andrew. We deserve to have some good times because we've had some difficult times.
Well, we actually had those good times, in a sense, survivable good times, because we were surviving through the pandemic. Governments threw the kitchen sink at the economy to keep the economy active. The point is, of course, is we did spend a lot of that. We saved a lot of it as well. But now we're getting the hangover after the party, Michael, and the hangover is inflation. And as these things would occur, it's sort of Murphy's Law. It would happen, wouldn't it? We've got a Ukraine war, we've got food shortages, and we've come a bit late in terms of tightening monetary policy. Yes, look, we have been paid forward. We now have to start paying it back, and that's higher interest rates. And of course, consumer confidence is being affected by a lot of the negativity around at the moment. We've moved into a completely different cycle in terms of interest rates, and we haven't seen this is better than once in a generation inflation. In fact, it's really heading up for, it could be the worst inflation environment we've ever had. And we've got to look back to the 80s and look at what the American experience was then, with Volcker, and he came heavy and consistent higher interest rates to crush inflation there. And I think that's what's going to take now, Michael, if that works.
Another important bit of news over the week, Andrew, was the Fair Work Australia's decision about raising the minimum wage in Australia. That's going to have quite some implications, isn't it?
Certainly the decision was on the upside in terms of the quantity that the Wage Commission has nominated. Basically is now matching inflation with those the minimum award, modern awards, and also the minimum wage. I mean, their argument always is to avoid poverty, particularly inflationary environment, that you can't marginalise those minimum workers. But of course, the concern here is that higher wages will fuel inflation. And that's the real danger in an inflationary environment, is that you start getting wages chasing prices, and then it becomes the dog chasing its tail, and the dragon really does get out of control then. But the offset, of course, is that the Wage Commission has a responsibility to avoid poverty becoming entrenched. But what will be interesting, Michael, is how the Wage Commission acts if we don't get inflation under control. Is this a precedent in terms of matching inflation with wages? Because as I said, we've got to pay this back now, Michael. If we keep trying to pay ourselves more and keep up with inflation, it will just fuel inflation going forward. We have to go through a period of hardship. That's why higher rates are being increased, Michael. It's putting the foot on the brake. And we do know that the outlook must be for reduced activity, because that's what the Reserve Bank's plan is to put on the brake and keep its fingers crossed that it's not a hard landing. Because if it is a hard landing, it'll be those lower paid workers that will likely pay the price with their jobs.
Well, with lower consumer confidence, property buyers are being a bit more cautious. They're taking their time. In New South Wales, I assume a number of them are wondering what's going to happen with the current budget coming out, and will they be paying stamp duty or won't they? Vendors, on the other hand, want to take advantage of the current markets and not see the value of their properties drop. Having said that, most sellers are buyers. So in fact, if you're swapping over in this market, that shouldn't really be a concern to you. But how did all this play out in the auction markets this weekend, Andrew?
Well, we had a bounce back in our auction markets on the weekend, Michael. Of course, it was the weekend after the Queen's birthday holiday. Numbers were quite low over Queen's birthday compared to last year. And we've seen that sellers are starting to be less engaged. And it was similar again, even though we saw a big jump in auction numbers following the break the previous weekend, as expected. Numbers were again quite low compared to the same time last year, the same weekend last year. But nonetheless, it was a significant challenge for markets in terms of auction numbers. We've seen a moderation in clearance rates, but the Melbourne market is probably standing up better. It's been around about those low 60s in terms of clearance rates over the last month or so. Other markets are certainly easing. The Sydney market below 60%. For the first time since 2020 in the depths of the lockdowns. We do move into the quieter period now, Michael. We can certainly expect to see fewer listings and an easing in clearance rates. But we've got to remember, Michael, it's winter. You know, people have made their decisions. The autumn selling season is now behind us. A lot of the FOMO stuff has brought forward demand. It's been satisfied. Winter is always a period where we typically see the market move into a hiatus period. This, of course, is being exacerbated by the fear factor. So a little bit of that fear factor will start to be challenged when we move into late August and September and the spring selling season. Housing markets are still well positioned, really, to cope with fear in the medium term. We're an undersupplied market. We don't have enough rental properties. Investors are attracted by high rents and holding yields. We've got all those first home buyers that are waiting to start their engines on the 1st of July with that extension of the first home buyer deposit scheme. Of course, open borders. Migrants are rushing back in. They've got to live somewhere, Michael, and that's either a rental or purchase property, and we're already undersupplied. And of course, we've got the student market heading back in, and they'll be looking for tenancies, particularly in those CBD markets or inner city markets in Melbourne and Sydney. So there's lots of demand ahead of supply going forward. And at the end of the day, Michael, you've got to live somewhere if there's an external demand force that is higher than available supply. And that will mean upward pressure on prices and rents. And there's nothing going to stop first home buyers, particularly trying to get out of the rental market, which is a nightmare at the moment, from taking advantage of that first home buyer deposit scheme. It's a 5% deposit. The government pays or covers the mortgage insurance. There are a limited number of places, first in, best dressed, And I would be surprised if first home buyers weren't, as usual, taking advantage of that. Again, adding to demand in the housing market. It will be a quieter period. It's the fear factor, the fear of being involved, right? We had back in 2018, 2019, but property decisions can't be postponed forever, particularly in an undersupplied market. And I think logically we will see, regardless of the nature of inflation and rates, that we will start to see the fear replaced or easing property markets. But make no mistake, Michael, this will be a journey over coming months, particularly as interest rates continue to rise. And of course, the fertile ground of hysterical clickbait continues to inform people that house prices are going to crash, which, as I constantly say, is completely challenged by history.
You were mentioning first home buyers getting back in the market. Clearly, there's an upper limit to what they can buy. And that, in my mind, is going to support the apartment market. Rising rents for apartment and affordability. People can't afford houses, so they're going to now be looking at townhouses, villa units and apartments. That should protect that market and create a narrowing of the gap.
Yeah, absolutely, Michael. And but look, it's a good story, and the media need good stories, and it's the perfect environment for it, where we're going to likely see a record increase in interest rates next month. Of course, prices were already settling before this ever even happened, because affordability had eased the market, taken all the fire out of the market earlier this year. So it was a process that was already occurring, that easing of price growth, because of natural cyclical forces or natural affordability forces, and now it's just being exacerbated, of course, by all the fear stuff.
Well, we're going to hear a bit more from the Reserve Bank over this coming week, so we'll have more to discuss when we catch up next week in next week's Property Insider video. Thanks for your time, Andrew.
Thanks, Michael.